So just to set the scene again for people perhaps new to the uranium space and obviously Vimy, I want to talk about a conversation we had recently with one of the American players, this sort of alleged price fixing, this kind of unofficial OPEC, as it were. You've got Kazatomprom, you've got Cameco, you've got Russia, you've got China, you've got some fairly major players with vested interests in the space and highly incentivized to keep the pricing at a point where junior explorers may find it difficult to come into production. I mean, what are your views on that?
Well, firstly, I don't think Kazatomprom and Cameco lie awake at night worrying about energy fuels. They're very small. They always will be. They're not a major producer. They're not sitting on massively large deposits like Kazatomprom and Cameco are. Cameco and Kazatomprom are on record and in personal conversations with them at wanting to see a higher price. Cameco particularly, they're a public company, and they would certainly like to see a higher price and increase their margins. We all know that the McArthur River mine shut because they cannot get long-term contracts at a price that will sustain production there. And Tim Gitzel has said on several occasions that they won't open it unless the price is sustainably higher. With Kazatomprom, I think Kazatomprom's interesting because they're a former Soviet republic. They obviously started mining uranium a long time ago. In fact, Kyrgyzstan right next door is where a lot of the uranium for the nuclear weapons program came from. So long history of uranium mining. The early part of this century, they started ramping up that mining using in-situ leach mining. It's interesting, because everyone has there's this mythology that the mining in Kazakhstan is actually really cheap, but we know that they were capitalizing their well development, and it actually wasn't that cheap, and we saw that in the IPO. In fact, we've been saying for several years that their costs were more like $20, mid-20s, and that's certainly been the case in the IPO. So Kazatomprom has come from a former Soviet republic where they measured output in terms of volume, not necessarily value. They were just pumping out material, whether it be lead pipes or ball bearings. They didn't act like a Western nation. So what's been really interesting about Kazatomprom is they've gone through a huge transition, largely through the efforts of Riaz Rizvi, to take that to an IPO. And to do that, they have had to basically Westernize their accounting system. And I know they had a lot of consultants in there helping them with that, actually establishing what their true all-in sustaining costs were. And we know that their true all-in sustaining costs are, as I say, in the 20s. So now they're going to start behaving, my view is they'll start behaving more like a Western style company, and they'll start looking at value over volume. And they certainly would like to see the price higher as well, because as we know, the Kazakh material that they get from their joint ventures, they have to sell at market prices, and the only market is the spot market, which I actually refer to as an arbitrage market.
Right. Okay. So, but don't the fundamental rules of supply and demand work? We saw in the last round that the huge number of companies started up. Some numbers quoted as as high as 500 companies in the uranium space. Clearly, too many, oversupply in the market. Prices have come back down. So you don't feel that these larger producers have the need to almost regulate OPEC style the pricing to stop that kind of surge of new entrants into the market?
Well, I worked in iron ore. I used to run an iron ore mine called BC Iron, which we took from first drill hole to first ore and ship in under 4 years. And BHP and Rio and Vale were often accused of the same thing. Now, these companies, they obviously are price makers because their volumes are so high that they can affect price. Are they behaving as a cartel? Well, no. If people have proof to the contrary, then they should put that forward. But it's a case of put up or shut up, really. So these guys are price makers. Now, they probably would like to see the price higher. And Tim Gitzel's on record saying that, and his actions speak louder than words because McArthur River shut.
Right, but when you say they want the price higher, I mean, is there a kind of cutoff, or they want market forces applied and it drive it up as high as it will go? Where does it stop?
I think what you'll find is that there was a good bit of work done by David Sadowski when he was an analyst at Raymond James. He did a paper in November 2015. Now, although it's a bit out of date, it's still a seminal bit of work. And I would suggest your viewers actually look it up. It's available on the internet. And what it was a paper on the incentive cost of new production. And he had some very detailed, David, I know David very well. He's someone you should have on your show, in fact. And he did a lot of work. He has some very detailed models. And what he did was he showed that at about $75 US, there's a massive plateau of production that could come on. And so that's, to me, that's the ceiling for anybody who has the capacity to manage the market. That's the ceiling. Now, obviously, you don't want to get close to the ceiling because you're going to bump your head. So, maybe dial that back $10 and you're looking at 65, 60. Now, of course, those are the numbers I like because those are good numbers for us. But when you look at the fundamentals of new supply, 75 does seem to bring in a lot of supply based on the work that David did. Now, obviously, with 5 years time gap, those numbers might change a bit, but the shape of the curve will probably remain the same. Now, I think both those companies have exhibited some enormous discipline when they could have just flooded the market like BHP and Rio did during the last iron ore downturn. I think a lesson can be taken from the iron ore space where you had FMG come in as an upstart, a lot of juniors, one of which I ran. And so at the level we're playing at the level that UR Energy and Energy Fuels are playing at, the big guys don't worry so much about, we're on the margins. And the important thing for us is, as with any commodity, there's a cost curve. Now, the problem with our business is no one really knows what that cost curve is. But with any commodity, there's a cost curve. And provided you as a producer can come inside that cost curve, then your competitors are the high-end producers in that cost curve. And those are the guys I'm thinking about. So the guys who occupy the first and second quartile, who are the big producers, and this is the same as iron ore and other commodities, nickel is a good one, I can't worry about them, right? The guys I need to target are the guys who are higher cost producers than I am. And so what I need to do is get in under them with my costs, keep my costs down and remain competitive. So, guys like us, the third quartile is the sweet spot. Now, a lot of juniors won't tell you that. They'll say, no, we're first quartile. Well, according to our price graph, which we supply, most of the first quartile secondary supply, and then you get Olympic Dam. So there's not a whole lot of room there. So, we look at that third quartile because you've got some buffer, but that's where you want to be, and that's what we target.
That's kind of interesting. You're saying that the majors, you're too small for them to worry about at this point. And I think you're right. If you look at other commodities, the majors have played it a certain way. But isn't there an opportunity for them, if they get the pricing right, they make it very difficult for some of the smaller players to get off the mark, even if they're sitting on great assets with a lot of pounds under the ground, they're going to run out of cash at some point and can be scooped up for huge discounts.
Yes, that happened in the iron ore space, absolutely, and that's always a concern.
But that's a game. That's a game.
Absolutely, and some quality assets there. If you sweat those guys and you pick them up for a song, you do two things: you've picked up a quality asset cheaply, and you've also sequestered the production for the foreseeable future. But the key thing is, let's look at the demand side. So the demand right now is dominated by America. We know that they've just gone through a hiatus because of Section 232. I can honestly tell you that the world has Section 232 fatigue, right? But let's look at how they manage their contracts. So what the utilities do is they do portfolio management. So what they'll do is they'll layer cake it, and they'll have base load, pardon the pun, they'll have base load from the Camecos, the Kazatomproms, the bigger producers. They want spread of supply. They want security of supply, and they like to see geographic and country risk spread. And so we know from our discussions, because we have a guy named Scott Hyman who works in the States and has worked with Cameco, worked with Dominion. We know how they layer cake their contracts, and we know that there is space for us in that portfolio management. So while Cameco and Kazatomprom may keep the price down, the utilities don't want to buy all the material from two users. So that's why if you're nimble, and I learned this in iron ore, selling iron ore into a space that was dominated by BHP, Rio, and Vale, that if you're nimble enough and you can stay inside the cost curve, you're going to find customers, you're going to sell your material. Your margins aren't going to be as high, but when you're a small company with lower overheads, and the key thing is, and I might add that my philosophy is paying dividends as soon as possible, you actually return a lot of value to shareholders.
Okay, that's really interesting. So you're saying that there is a niche for you in there. Obviously, you're saying lower prices, but the utilities are looking, I say, for a bit of certainty. So you think they'll continue with long-term contracts? That's part of their buying philosophy going forward. Nothing's changed there, because I think there's been a few hypotheses about the fact that why not stick with just spot price going forward? Given what pricing's done over the past few years.
That would actually be a good outcome, because if you actually freed the market up and it became a truly free market with a clearinghouse, and the spot price was a true spot price and not an arbitrage floor price, you would see the cost of uranium move towards the marginal cost of production, which on an all-in sustaining cost basis is $55 to $60. And on top of that, if you have return on equity, you've got a higher price. I would love nothing more than to see a true uranium market, but we know that's not going to happen. No. And part of that is because the fuel cycle takes 18 months to 2 years, and they just want to have that material waiting to go into the reactor, know that it's going to be in train. Steel mill shuts down, it's costly. Nuclear plant shuts down, it's really costly.
Yeah, it's true. So I guess given the way that you're painting this picture, you think there's a future for junior uranium miners like yourself in this space?
I do, and I think it's the miners who are ready to go now that are the ones that are going to benefit. So, no doubt, I've been, as I said to you earlier, I'm 58. I've been in the industry a long time. I've seen lots of booms and busts, and it's always the same cycle, right? It's the early movers who get the advantage. The early movers who do, corporately, they get taken out. They do mergers. They do all the things that happens when you're in the space that's growing, and then everyone comes along, and the next thing you know, there's 110 uranium miners, but they've missed the boat, right? And so it's the guys. We're a very small group.
You're permitted. You've got some drilling done. You've got some line of sight as to what's under the ground. So you feel things are still in your hands. This is not out of your hands. You're in control.
Yeah, I feel in control. We do a lot of research. We do. Julian Tapp, who works with us, is on the supply demand working group with the WNA. So we have a lot of let's call it inside information on supply demand dynamics. And, the fact that we have Scott Hyman working for us in the States gives us on the ground intel. He's connected to NEI, he's connected to WNA. So, we do have a lot of confidence. But as all good managers, you should have a plan B. And plan B is basically the Alligator River. And so there's a full definitive feasibility study completed on Mulga Rock. So that's technically de-risked, waiting for the tide to rise. Alligator River, while we in Australia aren't allowed to release preliminary economic assessments, we have said that it would work in this market.
Right.
That is a high-grade deposit, albeit at the moment small. We want to do more exploration to discover other deposits, create a satellite pit scenario, if you like. But the Angularly deposit at 1.3% works today.